Real estate investment practice problem using OneNote. Decision to purchase a home or rent calculation with a new format. Get ready because we're raising the stakes with real estate. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, practice problems, down in the 7130 decision to purchase home or rent calculation new format tab. Also note, when using OneNote, look at the immersive reader tool. Presentations, they're also in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, got the information up top, calculation on down below, looking at the decision between renting and purchasing, similar to a prior practice problem we have seen. However, the format will be different. The numbers will be different. I believe the format will be a little bit easier to follow in this way. We also work this out in Excel, so if you would like to work through this practice problem in Excel or simply use the Excel worksheet to customize it to whatever needs you personally have, you could take a look at that as well. So remember, as we go through this calculation, we're looking at it from the standpoint of we're currently renting and then thinking about if we should invest in the home purchase, currently renting with an outflow then for the rental of the $24,000. Looking at this in a similar way as a business would be looking at, say, a capital project, say an investment in a large piece of equipment or something like that. They do so by breaking down the decision into a cash flow scenario and then using our time value of money calculations with regards to the cash flow scenario to see if the investment would be worthwhile and which investment then we should be applying our money towards. Now, note that when we think about a home purchase, we have other factors involved as well. So we're looking at the financial factors, and then you could factor in on top of that, how much you value like a home purchase versus renting, how much you value the idea of like putting your roots down in a particular area or not putting your roots down and being able to have the flexibility to move from a particular area. So you want to put those into consideration. You also want to be considering the fact that there's a cash flow perspective to consider, meaning with the home purchase, you're basically usually locking down more of the cash flow. Your assets are then in the fixed asset of the home. So you want to make sure that you have sufficient cash flow then in that investment scenario to meet your needs as well. So just a couple things to keep in mind. So now let's go through the scenario. So notice that these capital project scenarios usually look like this. We're going to have an initial cash outflow. In this case, that would be the down payment that we would be making here, which is going to be the $80,000. Then we typically look at the differences between the cash flows. Usually there's going to be a cash flow benefit. In other words, if I put money in like a forklift or a piece of equipment, I'd have an initial cash outflow followed by benefits, reductions in costs or inflows from that purchase over time, and that's going to outweigh the cash outflow. So then we're going to look at the differences in the cash flows, meaning the difference in the current $24,000 we're spending per year versus the cash flow that we would have after we purchase the home. And then with the home, we got that end balance, the equity going up, which is one of the major confusing components, because unlike a piece of equipment, which we expect to go down in value, we expect the value of the home, hopefully, to go up in value. However, we don't get to realize that increase, that gain from a cash flow perspective until we either sell the home or refinance in some way. So we're going to have to consider how that would take place with regards to realizing that money on particular time periods in the future. That's the general idea. So let's take a look at what we have here. We got the purchase price, $400,000. So if we were to go from renting, which we're paying $24,000 a year, calculated as $2,000 a month times 12, $24,000 a year, we're going from that to purchasing a home, which costs $400,000. However, we're only going to be putting down cash flow of the 20% upfront. Then we've got the rental growth. We're going to assume, in essence, we're going to assume the growth rates to be the same, which is in essence inflation here. So we're going to say the rental growth, we lock in our rent year to year, but we expect it to be going up by, say, 2% each year. We're going to say the same for the property growth rate. That may not be the same. This is one of the major things that you might consider will differ. Possibly you're thinking that the property growth rate will be something greater than the rental growth rate. Note that when you're thinking about this growth rate, it's a huge component due to the fact that we're putting a large investment in an asset, the home. Not only that, but we're putting way more in than we actually have, leveraging, taking a loan out, in this case for $320,000. That means due to that leverage, if things turn out well, that could amplify our benefits because we're investing more than we have by financing it, loaning it, leveraging it. And if it turns out poorly, then that could be a big problem. It could amplify the problems as well, considering the fact that we leveraged it. So that this rate of growth becomes quite important when you consider leverage that's going to be involved. Also, just realize that if you're in a situation where you're saying, hey, I'm putting my roots down, I'm going to be here for 30 years, and it is what it is, I like where I'm at, I can make the payments, you might not be as concerned with the rate going up or down. Even if the rate went down, for example, it would be heartbreaking. It would hurt because you're like, my house is going down in value. But if you like where you're at, you can still make the payments. Then the house is serving the purpose that you purchased it for. If you're purchasing the home in order to have it for a financial investment that you expect to sell shortly, and especially if you're highly leveraged on it and you need the cash flow soon from the sale and there's a decrease, that's a lot more difficult to deal with. So it depends on what kind of your goals are from that perspective as well. Property insurance, $700. The maintenance is going to be $800. These are going to be costs we're assuming on the home purchase side of things. We're going to assume that inflation rate at 2%. So we're going to say that those things are going to grow costs at 2% over the years as well. The marginal tax rate will be dependent on your personal taxes. We're not taking the average tax rate because you're taxed at a progressive tax system. You are taxed at multiple rates, in other words. The marginal rate is the highest rate, and we use that because you're making this decision on the margin, as economists say, at this point in time. Therefore, the next dollars that you spend or save will be taxed at your current rate, 20%. Capital gains rates may or may not kick in because that's going to kick in when you sell the property. Capital gains rates are typically lower than the ordinary income rates, although that could change because they're always debating on how high the capital gains rates should be. But they might not kick in at all because there's a huge exemption for the home sale. So if it's your home, then those might not kick in. Property taxes are state and local level taxes. They'll be dependent on the state. We're going to say that the property taxes will increase as the property value goes up. It's going up at the 2%. Property value goes up at 2%. We're going to say the property taxes are 1.5% of the property value. How often does your state reappraise your property, increasing your property taxes? Depends on the state and your locale as to how often that might be. But they have an incentive to reappraise if you're in a period of increasing prices and then charge you more money. Selling expenses, we're going to say when you sell it, it's going to cost us 7%. So we have a cash outflow relating to the selling costs. The loan information, $320,000 loan, meaning we got a $400,000 property times 20%. Hold on a sec. 400,000 times 20%, 80,000 down minus the 400,000 means we're taking a loan for 320. 7% we're going to say is the rate, 30-year loan. We calculate the payments to be then, we won't go through the calculation here. We'll do it in Excel if you want to take a look at it, but we've seen it in the past using the PMT function, 2128.97 times 12. That means the yearly amount, 25,548. The equity that we started out, the starting cash outflow, 80,000, that being the deposit. Once we have that information, we can construct our amortization table. Looking something like this, we won't go into it in detail. We've seen it in the past, but I would always construct it because it's fairly easy to do in Excel, and it can give you a baseline to kind of lean back on when you do your calculations. So these are breaking out by month, starting out with a $320,000 loan, payments at the $2,129, about this number here, and the interest calculation at that 7%. Then we have the loan balance going down. Note, as we scroll down, the payments are the same. However, the breakout between the interest and the principal will differ. That's important to note because the interest might be deductible, whereas the principal is not. And therefore, when you look at your tax benefits, you can have a greater tax benefit in the beginning years than the ending years. This last payment, in other words, you make way down here, you only paid $12 in interest, which isn't going to help you on the taxes too much. So this is broken out on a month-by-month basis. We want to see it on a year-by-year basis, which we can do a couple different ways. We can do it basically with a pivot table. I won't go into detail with the pivot table. We've seen it in the past. You can look at it in Excel as well. But this would be the format of how to calculate the pivot table. This is the standard format that I like to see it in, usually by default, meaning instead of 30 years, that instead of 360 months, we can break out 30 years and have a summary of the total payments, the interest, the loan balance at the end of that time frame. However, in this case, we'd like to reformat this so that the numbers here, the years, will be up top in the horizontal column, the rows, and then this information will be in the columns. You can do that with a pivot table. Again, we won't go into it in detail here. We do it in Excel, but you could do that in Excel by reformatting the pivot table calculations and just pivoting, in essence, the columns here. So now we've got this nice format of the columns now being in terms of the sum payment, the sum of the interest, and so on, and the years up top. This is nice because that's going to be the format that we're going to be using as we do the rest of our calculations, which is a little bit easier to look at, I believe, and for most people. So we're going to then use this information to do some of our calculations with regards to the cash flow. If we then summarize this data, we got this information here, and then we've got our years going all the way out to 30 years this way, and then we've got our totals at the end. So in Excel, we actually reconstruct this table, which we've constructed with a pivot table using calculations, which is nice because then you don't have to reference to a pivot table when you do references, because you can then use another table that has calculations, and that makes it a little bit easier for you to adjust your numbers on the left and then have everything populate on its own. So check out Excel to see how and why we do that. We'll just depend on these numbers up top for now. Then we're going to calculate the property value. So the property value, we're going to say it started out at the 400,000. It's going to go up by 2%. So we can calculate that by saying, well, if it goes up by 2%, 400,000 times 0.02, it's going to go up by 8,000 in the first year, plus the 400,000. There's the 408 in year one after year zero. We can get there also by saying 400,000 times 1.02, or 102%, getting us right to the 408. If we did the same for year two, we could take that 408 times 1.02, 102%, and that would give us the 416, 160, and so on. So if we did that all the way out, you could see this increase, even at simply the 2%, can be quite significant due to the fact that we're starting off with a fairly high number. So we're up to the 724 after the 30-year time frame. So that'll have an impact on the equity that we would be generating, and that equity then is something that is great for our balance sheet, making us look good balance sheet wise, but it's not liquid, meaning I can't use it until I sell the property and realize it, or we take a loan out against it to get into that equity. So cash flow for the home purchase before taxes. So now let's consider what the cash flow would be on the purchase side of things, not the cash flow from the initial investment, the down payment, we'll look at that later, and not the cash flow from the sale, we'll look at that later, but the cash flow from year to year that would be resulting on the purchase scenario for things like the payment of the loan and so on and so forth, which we can then compare to the current place we are at, renting, cash flow 24,000 outflow. So looking at that, we could say, all right, the property taxes are at the 6,000. That's going to be calculated by taking the prior year value. So we got the 400,000 times the 1.05, which is 0.015, which is our 6,000. This 1.5% will vary depending on your state and local area, and how often they reassess the value of the property will vary as well. But we're gonna assume that it's going to increase by 2% per year, and they reassess it each year, increasing the property taxes, which is probably a kind of a more conservative type of approach to take, because they might not reassess it each year. They might do it every once in a while. But it is property taxes. It's a law. Anytime you talk about taxes, they can all of a sudden do something crazy. They could increase the property taxes. They can increase the rate and reappraise it and whatever. Just depends on the environment with regards to the political environment. So we're gonna say then the second year it's gonna be at the 408, our property value, times 0.015. That's gonna be the 6120. And then in year 2, the property value goes up to 416160 times 0.015. Takes us to the 6242, and so on and so forth with the property taxes. And then we have the insurance started off at the $700 for year 1. We're going to say it goes up. We're going to have to pay for insurance increasing with, in essence, inflation. We are assuming to be 2%. So if it's $700 in the first year, 700 times the 2%, which is going to be, let's say 1.02, 102%. It's going to be 714 times 1.02 is going to be that 728. So the expense is going up by inflation. Same with the maintenance. If maintenance started off at $800, it's going to then be 800 times 1.02, or 816 times 1.02, which is going to be 832, and so on. And then we've got the loan payments. The loan payments are straightforward because we locked in the interest rate and we have a 30-year fixed. So even though the breakout between interest and principal will change, the payment remains at the 2128.97 times 12 for the year, 25,548 about. So that's going to be key. That's an interesting thing, because if I compare this to the renting, remember I'm renting for $24,000, the major component of the home purchase actually stays fixed, where that rental amount's going to go up by the 2%, which could have an interesting impact as time goes by when we compare the cash flows related to the home purchase versus the renting. If we sum that up, cash flows for the home purchase at the 3348, the 33,198, the 33,551, and so on. Now, we also need to consider the tax implications, because some of this might be deductible for taxes, including the property tax and the interest that could be deductible. So let's take a look at those. We're going to take the property tax, which we can just copy up top. The thing with the property tax, however, is there's always debate as to whether or not state taxes, which are state and local, which property taxes are, should be deductible on the federal side of things. And therefore, they could cap it. So I'm going to currently say there's a cap at $10,000. And if there's a cap, then you might be subject to hitting that cap. So you got to keep that in mind. That will most likely be appropriate, or something you got to worry about more so when you're in the high cost of living states like California or New York or something like that. And I won't get into why there's a debate on that, but there's always kind of a debate on that. The Fed is kind of influencing the states by having the deductibility of certain taxes. Should that be the case? Should they reduce that, and so on? So that could fluctuate in terms of public policy. So we're going to say that it's going to be capped at $10,000 in this case. Again, you got to check the current law to see what will happen. And you can see all the way at the end, as our property taxes go up, then we're going to cap them at the $10,000. We also do that with an if formula or logic function in Excel. So you can look at that logic function if you want to work this problem in Excel, but that's going to be the idea of what is going on. Also note, when we look at these tax implications, you have to also think about the fact that if I get this $6,000 deduction for my taxes, those are going to be itemized deductions. So even though I got a $6,000 deduction and I might be itemizing, the question is, if I didn't have that $6,000 and I was renting, I'm probably not itemizing, due to the fact that these two things, property taxes and the insurance, are usually the things that push people over to itemizing. So that means that they're able to itemize, but the fact that you're able to itemize doesn't mean you're going to get the full benefit, say here, of $28,297, because if you were taking the standard deduction, you would have already gotten some of that in the standard deduction possibly. So the gap, or in essence, the difference between your standard and itemized deductions, is also something to take into consideration. So you could get a lot more detailed, in other words, with regards to your tax implications, and you probably should drill down a little bit more on that. You could do that with tax software running scenarios in a renting scenario. And if you're in a situation where you're not itemizing and then you buy the home and you are itemizing. Remember, you can't just look at the 28,297. You got to look at the impact on the taxes in part, and then see why there's a difference. And there might be changes also due to the fact that you have this gap between the standard and itemized deduction, which you're not really getting a full benefit of. You kind of take that out of this amount of the deductible amount in terms of your actual deduction benefit on it. All right, so that said, we're gonna continue on here. We got the interest payments, which we're gonna be pulling from our table up top. So now we're talking about the loan payments, but not the principal portion, just the interest portion of them. So that's going to be these items, the interest portion right here, the 22,297, the 22,62, and so on. So there we have those items. Adding those up, those would be our total deductible amounts. Then we used our marginal tax rate, not the average tax rate, but the marginal or top tax rate, and just multiply that out. So if I got a 28,297 deduction times 0.2%, and then we're going to have a tax benefit of the 5,659. So remember, you really have to run that through tax software to get a good idea of how close that estimate is, and then make any adjustments that you need to do running tax scenarios on it. But we're going to stick with that. That's going to be our tax savings. Therefore, you can think of it as, in essence, we've got a cash outflow for the purchase due to the loan amount, the property tax, the insurance, and then we get some of it back when we file our taxes, in essence, from a tax benefit, lowering our tax bill, possibly getting a refund of the 5,659 in year one. So the difference between the two is our net cash outflow from the purchase side of things. So now we want to say, okay, can I compare that to the cash outflow with regards to renting? This is our starting point. We're currently paying $24,000 to rent every year. We expect that to be going up by 2%, meaning $24,000 going up by inflation times 1.02 to the 24,480 times 1.02 to the 24,970. That's what I expect to be paying if I continue on the current route we're at with renting. And if I purchase the home, even after the down payment we put down, $80,000 up front, we're actually still paying more on the purchase, at least in the beginning years, and then it'll actually flip. So the difference between the two then, if I purchase, I have an $80,000 cash outflow up front, and that's my down payment, and I have this difference where I still have a net cash outflow from the renting scenario. That's the case all the way up to year 12, where that flips. Where now, at that point in time, the renting would be more than the cash outflow for the purchase. Why does that happen? In part because the rent is going up by the inflation of the 2%, and the home purchase, we locked in the rate, and therefore the major part of the home purchase, that being the payments for the loan, are kind of locked in. So we got that flipping that will happen here, net outflow, then it flips, and then you got this change on the benefit side of things, and you've got a benefit on year 30 with regards to the cash outflow for the purchase versus the renting. So taking that into consideration, then we've got to think about, well, what about the equity in the home? The equity in the home would be increasing as the value of the home goes up, but I only get to tap into that when I sell the home and realize it, or when I take basically a loan against it. So the cash flow from the home sale, what we're going to do is assume that we sold the home at each one of these years. We're not assuming, this doesn't mean that it's cash flows that happens each year. It's cash flow that we can assume if we decide to sell the home at each one of these individual years. So in other words, if I sold it in year one, I can sell it for $408, we're assuming, because the home value is going up from $400,000 by 2% to $408, $416, $160 if I sell it in year two, $424, $483 if I sell it in year three, $432, $973 if I sell it in year four, and so on. Going to take a look at that, and then if we have these selling costs, which we said were 7%, so in order to facilitate the sale, if I get $408,000 in year one times 0.07, I'm going to have to pay $28,560 in selling expenses. We're also going to have to pay off the loan balance. Now, where do we get the loan balance? We get that up top from the table we calculated for our yearly table that we calculated here with the pivot table. So the loan balance, if I bring this to the left a little bit, hold on a second, bring it to the left, all the way over. We've got the minimum loan, it was $316,749. The $313, these are what we're going to have to pay when we sell the home. We're going to have to get the proceeds and then pay off these loan balances for our cash flow. So that's the $316,749, the $313,264, and so on. And that gives us our net cash flow. So if I held on to it for 1 year, we've got the $408,000 minus the $28,560 minus the $316,749. That gives us the $62,691. And you can see that cash flow change over time over the 30 years going up to, after 30 years, if we held on to it, we got the $673,827. That is not the gain that we have. That's going to be the cash flow, getting the money and then paying off the loan. We also want to consider the gain and the tax implications related to the gain. There's not going to be any tax implications oftentimes if it's going to be our home, meaning taxes on the gain, due to the fact that if we held it for a long enough period of time, we would have that exemption amount that would kick in and wipe it out generally. But if our gain gets over a certain amount, $250,000 if single, currently I believe $500,000 married, then we can have this tax implication. So in other words, let's pick a year out here, and you have to hold it for 2 years. So notice these two calculations in year 1 and 2. I mean, if you sell it in year 1 and 2, you could still have tax implications due to the fact that you didn't meet the exemption requirement. So so in any case, just keep that in mind. But let's say we sold it in year 5. It was the $441,632. The selling costs, we're going to say, are the $30,914. Same selling costs we had up top. And then that means we've got the net sales. In other words, if I sold it for $441,632, I had to pay the selling cost, $30,914. I have net sales before I pay off the loan of $410,718. Then I compare that to my cost or basis, what I paid for it plus any kind of improvements minus any depreciation if there is any, is $400,000. So we have a gain in that case of $10,000. So we got the gain of the $10,718 here. The question, is that subject to tax? And we're going to say no generally, because if we meet the eligibility for the exemption, we get this huge $250,000 exemption, which wipes it out. So that means our gain for taxes has been wiped out. Therefore, we're not going to be paying any taxes on it generally. So notice that these first 2 years we had a loss, so we don't have to worry about taxes there. Also note that you wouldn't really have an exemption in those first 2 years because you wouldn't meet the requirements. You got to be in there for 2 years generally to qualify for the exemption. And then we don't have an exemption. We don't have any tax consequences because the exemption wipes out the gain all the way out here until we get past this amount, all the way out to year 29. Then we have a tax consequence. And that's because we're single. If we were married, then we get a $500,000 exemption currently. That would wipe it out as well. Note also that the tax rate might be different. It might be the capital gains rate rather than the ordinary income rate, which is usually lower. That rate could change as the law changes over time. So make sure you're taking into consideration current time frames whatever you're currently looking at. So there we have it. So basically no tax implications until we get out farther away due to the exemption generally. So then we got the cash flow after taxes, which until years 29 or 30 is in essence the same because we're taking the $62,691, for example, plus 0, and then that's going to be the 62 or minus 0, and that would be the $62,691. It's the same all till you get to the last couple years here where we had those tax implications. So now we got a difference in the cash flow due to the tax implications out there. So now once we have that, then we could do our long kind of complicated table here that looks intimidating, but not too bad once you consider it, because we're trying to look at the cash flow on a year-by-year basis, looking at it in terms of the sale that would happen in a particular year. So let's first just consider 1 year down here, and let's consider year 15 and try to ignore everything else that's going on in this table and just look at year 15. Let's say we assume to sell it after 15 years. So we hold on to the home. Let's look at the cash flows that happened up till that point in time, and then present value those cash flows and look at our time value calculations with regards to it. So if I purchased the home, if I was renting, I started off renting at $24,000, purchased the home, put $80,000 down up front for it, then we have the difference between the cash flows from my current position renting versus owning the home, which we calculated up top here. I'm at $24,000 in year one versus having more go out, $27,388. And so I have a net cash outflow even after the purchase, after that initial investment. So I'm still paying money, but that then will change around year 12, I believe it was. So we're paying money, more, all the way out. And then it actually flips here and in year 12, 13, and 14. So in those years now, I'm actually getting a cash flow benefit from the home purchase. Now, note, we're still got this benefit, or we still have this nice, huge sales price. So even though we're actually paying money out for this whole time frame, if I sold it in year 15, I would have that net change, whatever that net change is, and we would have the difference in the sales item here, the money we would get from the sales that we calculated up top. So now we're getting that benefit here. So if you look at just number 15, the question is, I've got this huge outflow of cash. Do I have the cash flow to put this outflow of cash up front in this scenario, which is higher than under the renting scenario? In this case, $80,000 up front, then we finance the rest. So that's not a cash flow thing. And then we've got the outflows, which are still higher than if renting under this scenario until you get out to year 12. And then it becomes a cash flow plus from a year-to-year basis after that point. And then if I sell it, I realize the equity, which is when it really kicks in, that increase in the value kicks in. So then if I was to value that stream of payments, the question is, what would be kind of the rate at which that series of payments would be zero? We're going to say here it's going to be the 7.12. So in other words, if I look at that stream of payments over the 15 years, I've got $166,697 cash flow benefit. But obviously that happened over the 15 years, so we got to consider time flow of money and what else we could have done with those initial cash outflows if I was not to put it into the property. What's going to be our return? In essence, the rate at which that series of payments would be zero, the discounting of them would be that 7.12%. So you could see we could do the same thing for each of these other years, looking at the same kind of calculation, breaking this out on a year-by-year basis as if we sold the property, realizing the cash flow at that point in time on a year-by-year calculation. And you can look at the impact in terms of the internal rate of return as well. Just to get an idea of that a little bit more clear possibly, is if we break out year 15 here, so we got the same cash flows, $80,000 up front, and then the difference in the cash flows still having an over and above cash flow higher on the purchase versus the renting for these years up until year 12, I believe. And if we discount each one of those years back using the discount rate of the 7 point whatever rate it was, that IRR rate, then we could see what this basically means. Now remember that 7 point whatever rate that we're using doesn't mean inflation rate. The inflation rate might be part of that, but that could include the gain that we're looking to basically be receiving from our investments, meaning what are we getting for this initial investments or outflows that we're putting out up front. So the $80,000, if we discounted back, is currently $80,000 because it's at period zero. If I took that $3,388, present valued it back 1 year, back at that 7 point whatever rate it was, then we would discount it at year zero to $3,163. If I took the $3,082, discounted it back 2 years using that 7 point whatever rate, we'd get to present value dollars of $2,685. Present value dollars not meaning after inflation, meaning including in essence the rate of return at that 7%. And if I go all the way out to this $264,992 cash inflow, which is in essence the big payoff that we're getting from the purchase, and discount it back to the current time period, we would be getting to that $94,460, discounting it back at the 7.12. If I sum up this stream of payments, which in essence are the present value amounts for these cash flows up top, if discounted back at the 7.12, we get to zero. So that's basically what this means. That's the rate at which, if we discount all those payments back, would be at zero. That doesn't mean that we didn't make any money. Because that might be the case for purchasing power if that 7.12 was in essence inflation. What that means is basically this 7.12, we would want a rate at which we're comfortable or happy with the rate of return that we're going to be receiving, factoring in things like risk that would be involved and things like the cash flow situation differences between the two options. And, so we want to figure out what rate of return we would be comfortable with in order to receive it there versus putting our money somewhere else and possibly having our risk-adjusted return of taking these initial outflows and doing something else with them versus putting them here and getting a rate of return and get an IRR rate of return of the 7.12. So that's going to be the kind of idea of this internal rate of return. You can think about like the hurdle rate or the rate at which you'd be comfortable getting that return that would be inside of this rate of return in order to make the investment in one decision versus another. Obviously, you can look at other long-term kind of investment decisions and figure out what their, rate of return would be and see which one would be higher and lower and look at your best place to put your money. However, you also want to consider when you're thinking about these rates, the factors that are involved, including what return you're comfortable with, factoring in the risk level and the cash flow assumptions and, just your overall benefit, what you think you would be most enjoyable living in, and try to factor those things in that might not be as easy to quantify just from a financial standpoint when you're talking about a home purchase as well.